In this lecture, we are going to very briefly discuss the capital asset pricing model, also known as the CAPM. Luckily, we've already done all the theory necessary to understand the CAPM. The CAPM is really just a philosophical discussion and a renaming of some variables in the equations, which we've already discovered. So what do I mean by that? Well, earlier, we looked at the portfolio with the maximum Sharpe ratio. We call this the tangency portfolio. Why? Because when we invest in this portfolio, in addition to a risk-free asset, we get a line tangent to this point on the efficient frontier. So the CAPM simply renames these items. The tangency portfolio is called the market portfolio. Furthermore, this line is called the capital market line, or the CML. When we talk about the market portfolio, we say that it has return R sub m. The expected return is therefore mu sub m, and its corresponding risk is sigma sub m. So again, all we've done is rename the variables. So what's the philosophy behind this renaming? Why is the tangency portfolio the market portfolio? Well, this all stems from the efficient market hypothesis, which, as you recall, we first encountered in our discussion of time series forecasting. We assume that every investor has the same data, and every investor is a mean variance optimizer. Because of this, they have to choose the tangency portfolio with some mixture of the risk-free asset, simply because there is no better portfolio. This is the portfolio that gives you the maximum Sharpe ratio. Because the tangency portfolio is held by all investors under this model, then this is the market portfolio. Let's look at an example of how one might use the capital market line. Suppose that you're considering investing in a project to build Silicon Valley's next disruptive technology. Let's say that the price of one share today is $1,000, and this is expected to be worth $1,200 in 1 year, with volatility 20%. The current interest rate, R sub f, is 3%. The expected return on the market portfolio is 15%, and the volatility of the market is 10%. Let's determine whether or not this investment is worth considering. We can calculate the expected return of the investment as 1,200 divided by 1,000 minus 1, which is 20%. But according to the CAPM, if we take on a risk level of 20%, we should expect the return to be 3% plus 15 minus 3 over 10 times 20%, which is equal to 27%. Remember, this is the equation for the capital market line. So what can we conclude? We can conclude that this investment is not worth considering. According to the Sharpe ratio of the market, we should demand a return of at least 27% on an investment with 20% volatility. We would expect more reward for the given level of risk. There are some other interesting points about the CAPM, which are worth discussing. Although we won't go into the derivation right now, there is another line called the security market line, which tells us the return on each individual asset. The basic idea is, it is a linear regression of the asset's excess return on the market's excess return. That is, the expected return of asset I minus the risk-free rate is related linearly to the return of the market minus the risk-free rate. Note that the excess return of asset I is also called the risk premium. It's how much more return you can get for taking on a certain amount of risk. The excess return of the market is also sometimes called the market premium. This relationship between the risk premium and the market premium is controlled by beta sub I, the coefficient. It tells us how much asset I moves relative to the market. If beta is greater than 1, we consider this an aggressive investment. That means you're willing to take on more risk in return for more reward. If beta is equal to 1, we would say that this asset has average risk. If beta is less than 1, we would say that this asset is not aggressive. Because of this, in the capital asset pricing model, beta is actually the measure of risk. This might seem contrary to what we discussed earlier, where we said that sigma was the measure of risk. So that might seem confusing, but rest assured, everything is consistent. Large beta means more risk, and small beta means less risk. This is called systematic risk or market risk because it's risk that, as you can see from the equation, depends completely on the market. It is also unpredictable, assuming the markets are efficient, since the market itself is unpredictable. Another interesting fact is that when we plot the security market line, the independent variable is beta rather than the market premium. That is, it's a plot of the return versus beta. According to the CAPM, all assets should fall on this line. If they do not, then that suggests those assets are mispriced. This should help you understand why we call beta the systematic risk. It says that the risk premium systematically increases or decreases as you adjust beta, the risk. When your risk goes up, your return goes up. When your risk goes down, your return goes down. So the CAPM says that all assets should fall on the security market line. But let's be clear that this is an assumption of the capital asset pricing model. This is part of the model, but this lecture is not an assertion that the model is true. Only if you believe the model is correct would you believe that this is true. Another point worth repeating is that, although this equation seems quite random, it can actually be derived from the modern portfolio theory that we just discussed. It involves a little calculus, so it might be best left for another lecture. Intuitively, though, you can recognize that this equation has the same form as the equation we derived earlier, which showed that the Sharpe ratio of any portfolio on the capital market line is the same as the Sharpe ratio of the market portfolio. If we combine both the sigmas together into a single constant, we see that the excess return of any portfolio is proportional to the excess return of the market portfolio. So what is the purpose of the security market line and the CAPM? If we look very carefully at the name of this model, it's called the capital asset pricing model. That is to say, it's a model that helps us to price an asset. In other words, we can estimate, under the assumptions of this model, what the price of an asset should be. If we find that an asset is mispriced, investors can use these signals in order to make investment decisions. If an asset is undervalued, that would be a signal to buy. This assumes that the market will eventually correct itself so that the asset goes to its correct price. If an asset is overvalued, that would be a signal to sell. There is yet another line called the security characteristic line, which is similar to the security market line, but adds a time index. Note that we also take away the expected values and replace them with an explicit noise term. When we do this, this is what we get. So all the capital R's are random variables. Note that all of these terms depend on time, except for beta, which is assumed to be constant. Another way to represent this is to replace the excess returns with a single symbol. We'll say R prime is the excess return of R. So now our equation becomes Ri prime equals beta sub I times Rm prime plus epsilon. A more elaborate model involves adding an alpha term to our previous equation. Note that, according to the CAPM, the expected value of alpha is 0, which is why it hasn't appeared until now. Including alpha allows us to account for the possibility of mispricing. As you recall, when we fit a linear regression, we get both a slope and an intercept. Thus, alpha represents the intercept. It tells us how much return cannot be attributed to the market. In statistical packages such as R and stats models, when you fit a linear regression, you also do various statistical tests, including ones to check whether or not your slope and your intercept are statistically significant. So after you fit your model, you'll get a p-value telling you whether or not alpha sub I is significantly different from 0, violating the assumptions of the CAPM. So what is the interpretation of alpha? If we find that alpha is significantly different from 0, then the security is mispriced, at least according to the assumptions of the CAPM. If we find that alpha is greater than 0, this means that the security is underpriced. In other words, the returns have been too large on average. This would be a buy signal. However, it's important to recognize that if we reject the null hypothesis that alpha is equal to 0, all we have done is shown that the security was mispriced in the past. There is no guarantee that this will hold true in the future. As a summary to this lecture, it's worth noting that the capital asset pricing model is most certainly wrong. Let's consider some assumptions made by the CAPM. Number 1, it assumes that the markets are in equilibrium. In other words, for each asset, supply is equal to demand. This is not true. Number 2, it assumes that every investor has the same forecasts of expected returns and risks. Again, this is most certainly not true. Number 3, it assumes that every investor is a mean variance optimizer, and every investor holds a combination of the tangency portfolio and the risk-free asset. Again, not true. Considering these facts, it may be surprising to you that the CAPM is still taught to financial engineering students around the world. In fact, the CAPM is still a useful pricing model, as shown by the example earlier in this lecture. It is still a fundamental topic of financial engineering, and it forms the basis for more advanced techniques. In fact, if you continue your studies in financial engineering, one of the topics you will learn about is factor models. The CAPM is considered to be a single factor model because the return on each asset is completely determined by a single factor, which is the market. Fama and French developed a model called the three-factor model, in which the return on each asset could be regressed on 3 separate factors, one of which is the market. Furthermore, one can use statistical methods, such as PCA and factor analysis, to obtain what are called statistical factor models. These are unsupervised machine learning methods, which try to figure out what the factors might be without you having to assign them explicitly.